Thank you for the opportunity to speak to you all. Today, I'll provide a comprehensive overview of the anode grade coke market, covering supply and demand fundamentals and outlook, price forecast, and key topics. We will lay out the differing price levels for each coke grade, the regional price differences, notably Europe versus US, China, and rest of world, and also the aluminium anode market outlook. For those of you that don't know CRU, we're a metals and mining research company and have a team of more than 20 analysts who track the aluminium market. The CRU Aluminium analysts are based in the US, the UK, India, and China. I welcome conference attendees to visit the CRU online website, where you can find our methodology and definition documents also for carbon products. So when looking at forecasting, I think it's important, given the current status of the world, to look at the economic overlay of our forecasts. So most of the world is emerging from lockdowns, but the US, Brazil, India, and others are seeing COVID-19 infections rise, and that is also true here in Europe as well. Health experts have warned us of an upcoming second pandemic wave. If this leads to further lockdowns, how will governments react? Will further fiscal stimulus be forthcoming when debt is soaring? When might a vaccine be available? COVID-19 has generated many uncertainties, leading to diverse macroeconomic forecast possibilities. So in terms of the shape of the recovery, which frames our supply and demand outlook, the global economy is recovering from the worst of COVID-19. The first phase of the economic shock was in early 2020, really focused in China, where a strict countrywide lockdown greatly reduced economic activity in Q1. Similar national lockdowns then occurred in Asia, Europe, and the Americas. We're now in the midst of the second phase of the crisis, a sharp rebound in economic activity. This is in part a catch-up of some of the activity which would have occurred during the lockdown. And then once this initial boost passes, the pace of the economic recovery will slow. This slower return to pre-COVID-19 levels will begin in Q1 2021 in what we call phase 3. And by 2022, the economy will have recovered, but there will be lasting impacts. This could be in the form of higher saving rates, sustained higher unemployment rates. That means we do not return to pre-COVID demand trends. So in terms of the aluminium market, this chart here shows China's anode demand by province, and you can see that growing over time. The strong rally in the SHFE aluminium price has accelerated due to the ramp up of new smelter capacity and restarts of idle capacity. Aluminium smelters that close capacity due to low prices or accidents have been incentivized to bring back capacity online swiftly. CRU estimate that nearly 700,000 tons of aluminium smelting capacity was closed in March and April. Over 150,000 tons of this was located in Qinghai and Inner Mongolia and Guangxi, but has since restarted. The remaining 500,000 tons in Shanxi and Gansu and Liaoning remains idle due to various reasons, but potentially could come online very soon. Looking at the world ex-China in particular, there are some key smelters which are important in the world production growth, but each have individual issues. There's Iraq in Iran, the 230,000 ton smelter, has seen significant reductions in output since the outbreak of COVID. The Iranian Mines and Mining Industry Development and Renovation Organizations reported that utilization rates were in the low 20s, 20% earlier this year. We have Asahan in Indonesia. That's the Inalum project, is expecting delays of a 30,000 ton expansion, which was expected to be commissioned in 2021. In Canada, Bécancour, Rio Tinto, was confirmed Q2 operational data that the smelter had reached over 90% utilization by the end of that quarter. But there had been some disruption there over the last 18 months, so that's an important contribution to global growth. Kitimat in Canada, production in Q2s remained 24% lower year on year after disruptions. However, output was marginally higher than the first quarter of the year. And then if we look at two of the most interesting smelters, San Ciprián in Spain, which is Alcoa's reported significant and recurring financial losses at the facility, They've stated that to continue aluminium production there is not feasible with the high energy costs, and we expect that smelter to now close fully in Q1 2021. And then there's TY Point in New Zealand, majority owned by Rio Tinto, and there's an expectation that they'll be closing their 360,000 ton smelter next year. The decision marks the end of a strategic review that began in 2019, and it's due to the power costs once again with Meridian Energy. So let's move on to the carbon market. For carbon, it's the low sulfur petroleum coke availability that's driving market discussions and price concerns. This is fundamentally an oil and oil product demand story, and thus one that the carbon market are largely price takers and cannot influence coker supply of raw materials to process. We see curtailments both at the coker and refinery level in a number of key regions, most notably in the Americas, where third-party GPC exports have been an important component of the international supply chain. China are now importing green petroleum coke, competitively landing cargoes versus domestic availability. CPC prices should be rising globally as calciner margins are squeezed, but smelters are fighting hard to keep a lid on prices. With the Chinese winter heating season approaching, CRU is assessing the likelihood of carbon plants and the overall supply outlook and what the impact is going to be there. Just looking at this chart here, we can actually see a fairly stable period in both Europe, in Middle East delivered, and in the US Gulf Coast. And there's been very little reaction over the last 18 months in terms of price increases, despite some of the tightening in the green coke market. This is likely to change in the next quarter, but as you can see from Q4 2018, we've come down from very high numbers, and even those are not anywhere near the original highs if we look further back in the period. So in the multi-year, we can actually say that we are at multi-year lows, and therefore we should be starting to see a recovery despite what's happening in the rest of the world. Here in China, we break down prices into the 3 different grades that are supplied by the Chinese Trade Data Association. So that's number 1 for the ultra low sulfur, 2A2B for the mid sulfur, and 3A3B, which is generally considered anode grade. And then for China export prices on an FOB basis, those are generally the sulfur grades between 2 and 3% sulfur there. So these prices are available on a monthly basis, and we see that as of April and into May, there's been a strong recovery in prices, and that's because the nationwide lockdown was highly effective. And once the smelters ramped back up and labour forces had returned from the Lunar New Year, they were allowed to travel outside of their provinces, return to their place of work. The economic activity picked up rapidly and pretty much reached full utilisation and prior levels, certainly in the metal industry, that we're seeing in January and February. So that meant that demand for coke has genuinely increased. That is real demand, and that is a price reaction because of that. However, it's the green coke market, here seen in dollar terms, obviously traded in renminbi domestically, that you can see in the chart below. It is that green coke price rally back up above 2019 levels and perhaps approaching 2018 levels over the next couple of months that has been driving demand. And we'll have a look at the low sulfur green coke market later and explain why that is really the key to this whole market at the moment. Now, I've just got a selection of slides here. We're looking at calcined coke prices alongside coal tar pitch and anode prices against the LME price and against the SHFE aluminium price. Now, this one is for Europe. I have coming up North America and China. I just wanted to allow the delegates to see these charts to show you that as a percentage, the coke price is actually a low component of the aluminium price. And that's historically as well. But if we look back 5 or 6 years, it would be a much higher level in some regions. And also when we consider how painful some of the power contracts have been and how high some of the alumina input prices have been over the last 3 or 4 years, calcined coke prices have diverged. They are relatively low. That is the case for Europe. It is also the case in North America as well. Here you also see that there is a much more balanced coal tar pitch market, but the US Gulf and US West Coast are exporters of coke into world ex-China versus the LME price. And here we have the Chinese price. It's a little more messy in there. We have the anode price as well for your comparison. But there is still that divergence, and we could say that coke still is a relatively cheap product for the aluminium industry. So here is the Chinese calcined coke balance in a graphical sense. So with the Chinese economic resurgence in full swing, we've seen a higher level of activity during the last 3 to 6 months, probably more so than we would have even predicted in our best case. So as such, production and demand numbers for Chinese CPC have continued to be revised higher to reflect that improvement. China's CPC production in 2020 is forecast to reach 17.8 million tonnes, falling to 16.8 million tonnes next year. CRU forecast production to rise from a low of 16.3 million tonnes in 2022 to 17 million tonnes by 2024. The reduction is important to equalise the market balance, especially as new capacity comes online outside of China. From a demand perspective, CRU expects CPC consumption in China to rise from 15.5 million tonnes in 2020 to 16.2 million tonnes next year. By 2024, we expect 1.7 million tonnes of additional consumption to have been generated. So that's a growth rate of 2.2% over the forecast period. Now, in world ex-China, we got a much bigger breakdown here. CPC production in world ex-China this year is forecast to be 11.2%, rising to 11.2 million tonnes, rising to 13 million tonnes next year. Further growth throughout the forecast period will see output hit over 14 million tonnes by 2024. So that's a 4.2% growth rate. World ex-China CPC demand in 2020 is forecast to reach 13.4 million tonnes, edging higher to 13.5 million tonnes next year, and then eventually breaching 14 million tonnes by 2023. So rest of world consumption for CPC is set to rise at around 1% year on year. There are some noticeable regions. I'd just like to touch on the Middle East. CPC demand in 2020 will be 2.6 million tonnes, rising gradually. Production in the regions increased with 1.2 million tonnes produced this year and 1.8 million tonnes expected next year. The region should supply more than 2.1 million tonnes from 2023 onwards. Also in other Asia, CPC demand is strong, growing 3% over the forecast period, from 2.6 billion tonnes this year to over 3 million tonnes in 2023. Production more than meets that requirement, with output in Asia ex-China in 2020 at 1.8 million tonnes, rising next year by 500,000 tonnes to 2.3 million tonnes, and eventually reaching 2.6 million tonnes. As you can see, the market generally balances itself, and we are starting to see a much more orderly market in 2021. So the Chinese winter heating season. We know that China's Ministry of Ecology and Environment published a letter that is focusing on the Winter Air Pollution Comprehensive Control Action Plan. That's for 2021. And that was released back in September. 39 industries were covered by the action plan. Obviously, that includes aluminium and also the carbon product and industries. So the winter cuts will be implemented based on the enterprise performance classification. This year, the winter heating season is defined as the 1st of October to the 31st of March next year, so 6 months in total. And that's the same period as last winter heating season. The policy affected areas include the original 26 plus 2 cities in 4 major heavily polluted provinces in China. So that's Hebei, Henan, Shandong and Shanxi, and some additional cities in Hebei and Henan. The list of policy affected cities in the upcoming winter heating season also includes 4 cities in Shanxi province, which was not included last year. However, it should be noted that calcined petroleum coke and anode capacities are very small in these cities outside of the 26 plus 2. So the carbon product industries obviously are on that list, the key affected industries. Based on this, different groups of carbon plants will have to undertake different measures depending on heavily polluting days. Also depends on what group they have been put in, A, B, C or D. A group will not need to reduce production on heavy polluting days or cut production only if they want to at their own decision. For B groups and industries that are ranked under B, emission reduction action will be taken based on various production requirements. So compared to last year, the plan for the upcoming heating season will be stricter and the policy affected areas will be broader. Although located in a less polluted South China-based province, Jiangsu provincial government has also issued a control plan for the heavily polluted days there. The policy indicates A group or national leading level industries could be exempted from production cuts at their discretion. However, the actual impact of this year's policy will be questionable. Over the past few years, China's implemented several policies to restructure the carbon product industry towards a more efficient and technically advanced direction. Therefore, most carbon industries in the 26 plus 2 cities are either national leading level or provincial leading level, so that's A or B. This means the production cut in the upcoming winter heating season will be very limited. This is very different from 2018 and 19, where the winter heating season was the key story and disruption to the market for both anode grade coke and also for aluminium. So CRU expect the demand for carbon products in Q4 to remain strong due to the newly built aluminium smelter ramp-ups. To satisfy this additional carbon demand, the producers in the policy affected areas will try their best to achieve ultra low emission standards that are put here in the form you can see to be exempt, and then any production cuts will be minimized and they can maintain a high utilization rate throughout. Also, we know that local governments will encourage carbon industries to continue to operate because they have certain standards they wish to meet in terms of employment rates and also local GDP growth. Okay, so here's to the hottest topic at the moment, and that is low sulfur green coke imports into China. Now, traditionally, we had mentioned that the South American low sulfur green coke was a key component in balancing the global market. That coke was sold on a third-party basis by the likes of YPF or Petrobras, and it was consumed by merchant calciners in a variety of regions, but generally it was not heading into China. China was well balanced in terms of green coke. They had enough oil refinery and coke capacity to supply themselves. However, over the last 6 months, we have seen a lack of coke, green petroleum coke, being sold out of South America. This is due to well-known issues in terms of refinery throughput, the coker utilization rate, the quality and consistency of the product. So there simply is less coke being produced and therefore offered for sale. But the fewer cargoes that are available for sale are being bought and sold into China by traders and being sold to merchant calciners. Now, the Chinese domestic prices are high, that's true. And so on a landed basis, we've seen cargoes being sold on an FOB basis at $200 a ton for 1% green coke and landed at $230 a ton, and it still makes financial sense. But the key factor here is the favorable credit terms. China will continue to be aggressively buying world ex-China cargoes, because when they do so, they get anywhere between 30 to 90 days of credit. This is versus buying domestic green coke, where they are often required to prepay by 30 days. So these terms, they obfuscate what is normally just a standard financial play in terms of landed cost versus domestic ex-works. This will continue to be a key topic because money is tight, the margins are tight in China. So we would expect that China to continue to import this low sulfur green coke, and that's going to continue for the next 6 months. We don't really see oil refineries debottlenecking particularly effectively over the next 6 months in China. And there is that genuine increase in consumption driven by the ramp ups and restarts of aluminium smelting capacity in China. That's really where all of the growth is. The quality specs that they're importing are high and they're consistent and they're well known, and the calciners are able to blend it effectively. The landed cost is still currently below the domestic ex-works price, but as I say, we do expect them to continue to purchase even when the arbitrage doesn't look like it should make sense. So in terms of how long will this last for, we actually think this tightness will continue for the next 3 to 6 months, certainly into Q1 next year. All eyes are watching this price because people will use it to assess their margin, and when they're discussing contract negotiations or spot cargoes, it is a very important component to that. So if we look at the forecast here, this forecast doesn't really include the last 3 or 4 weeks of aggressive price action in the China export market, where prices have jumped nearly $50 a ton month on month. But let me just go through some of these prices here, and generally they are going to be up around $10 to $15 over the next quarter versus this forecast because of what we're seeing in terms of short-term price action. So it's the impact of the raw material costs that is weighing heavily on the outlook here. This applies to all region. Europe maintains a structural oversupply, and the weaker demand profile is the worst globally. That's because the auto demand and wire and cable demand is very low. There are smelters that are closing. There are also smelters running at lower amperage, and it's a very well supplied contract and spot market for anode grade coke. It's the Chinese domestic coke price that surprised us in terms of the duration of the rally, and really there's no short-term response that green coke producers or integrated calciners can do to ease these conditions. So the Chinese Anode 3A, 3B GPCX works price forecast, we increased it in Q3 by $20 to $170 a ton, a level not previously seen since the end of last year, and that's just due to that demand pickup. Q4 2020 we forecast now to be moving up towards $200 a ton. In terms of the CPC, we had major revisions because we'd failed to hit the multi-year lows in Q2 in the mid 100s, and instead it was just down $20 quarter on quarter. Q3 2020 estimates are now $20 above our prior estimate, with trades expected to settle well over $200 a ton, moving up to about $220 a ton in Q4. With an easing of cost pressure in 2021, we have lowered our forward guidance. 2021 at $230 a ton, gradually rising to $270 a ton by 2024. Chinese export prices for CPC have similarly been revised higher, with the lows of the year now being passed in first half, and the price strength expected quarter on quarter to increase. So we had $250 a ton in Q3. Now, originally we were expecting the price to rise to $260 a ton in 2021, but we are seeing prices at $300 a ton FOB at this time. So the domestic price is going to be pushing up behind that as well. In North America, the US Gulf Coast has been largely unchanged throughout this year. However, the demand side weakness means that the stronger price response is unlikely. However, they are very exposed to the high green petroleum coke prices, not just in the low sulfur, but also in the medium grade. Therefore, we are starting to expect prices to move above $250 to $260 a ton on a US Gulf Coast basis. These contracts will likely be settled in the US, in Europe, and in Middle East in the first couple of weeks of November. We do not expect contracts to be left for completion into December, just given the large amounts of uncertainty and the likelihood of further lockdowns. People want to secure their books. So what about the risks? Well, they're really overarching risks to this outlook. Adding the policy dimension on top, we generate our GDP forecasts, and the COVID-19 restrictions help determine the depth of that downturn. So the more severe the restrictions, the worse the effect on economic activity. And in contrast, when we look at policy effectiveness, it helps determine the duration of the downturn. So effective policies cushion the impact caused by restrictions, and that promotes faster economic recovery. So effective policies, if they're timely and appropriate and generate positive responses from consumers and firms, that's what they're aiming for. So those are our two, we call them model levers. And in terms of the carbon market, these are the key takeaways, and that is that low sulfur green coke prices are going to remain bullish into next year. There is no downside currently to the price action. In fact, we do see continued high prices. The demand from smelters in Asia continues to be strong, particularly in China, but also outside of China. We see growth in places like India as well, adding capacity. The calcined coke supply in Europe, it needs to consolidate. We're expecting integrated calciners to perhaps offer less material next year. Certainly the region is long, and on the CIF Rotterdam basis, the prices are struggling, although higher prices from the US and China on a delivered basis are high. The region itself is structurally long, and we do expect some consolidation over the next 18 months. But the general theme is calcined petroleum coke anode prices are low compared to the multi-year, and they're low versus where the aluminium price is right now at $1,850. So we should see that as a positive for price action going forward. So thank you very much. Thanks for your time. On each of the slides, we've detailed the CRU reports that have been used to compile that data and commentary. So if you'd like any more information, please do either get in touch with myself or via the website or via any of the other conference delegates. So thank you very much for your time, and enjoy the rest of the conference.